Hi, everyone. Welcome to the Capital Raiser Show. I'm your host, Weston Walker, and we interview only the best entrepreneurs and investment managers. Shout out to the sponsors that make this all possible, the Family Office Club, Capitalist Pro, and Invest Next. Today, we have Brian Burke, the founder and CEO of Praxis Capital, a 35-year track record, and he's raised about 350 million and managed over 850 million in real estate investments. And he also wrote a best-selling book called The Hands-Off Investor. Brian, welcome to the show.
Thanks for having me here, Weston.
Of course. Yeah, so let's go into your background. You have a long track record in the real estate space. You've also wrote a book for investors that are interested in investing passively in the real estate space. So go into how you started in real estate to almost $850 million in investments.
Yeah, it was a long journey, that's for sure. I started 36 years ago as a small-time house flipper, grew my business into a small multifamily, which then about 20 years ago, or I guess, well, about almost 25 years ago now, morphed into more larger multifamily properties. And through the course of that period, we've bought over 4,000 multifamily units. I've sold over 3,000 of those, so I don't have as many left. Right before the market crashed, we managed to get out, so
Nice.
we got that going for us. And now we're we kind of sat on the sidelines for the last 3.5 years because the market's been like catching a falling knife. Haven't bought anything, and we found a really interesting opportunity in a new space for us in assisted living, skilled nursing, and memory care facilities. So that's kind of our current real estate focus is now in that sector.
Got it. And you also help investors invest into these projects alongside you. And you wrote a book on the whole topic. So could you give a little detail on what investors should be aware of and what they should look for in these type of passive investment opportunities?
Yeah, I wrote this book to help passive investors make passive investments into syndications because there just wasn't a lot of really good, concise information out there to show investors what they should be looking for. And a friend of mine lost her entire life savings investing into a passive syndication when she didn't know what to look for and looked for the wrong things, unfortunately, and made an investment with the wrong sponsor. So I thought it was really important to try to at least maybe help one person avoid that, that same fate. And so that I think is really important because what investors need to look for that they may not be thinking so much about is the moral character of the sponsor they're investing with, the experience of the sponsor they're investing with. They focus a lot on kind of the type of assets and where the assets are and how the assets are underwritten. But some investors tend to put less focus on the actual personalities and human individuals involved in the investment program, and that's really where the rubber meets the road.
Interesting. And a lot of people say, the number one thing you should look for is the sponsor and the track record. So could you go into more detail on how to vet a sponsor if you're investing with them?
Yeah, I mean, to start with, you want to look at that sponsor's experience and not only just experience as a general category, but break that down into subcategories of experience. For example, how much market cycle experience do they have? Have they ever been through a market that's gone down and then back up again, or have they only invested during an upward cycle? Do they have full cycle experience, meaning have they bought, managed, and successfully sold assets, or have they just been buying stuff and have never actually proven that they can successfully exit? Do they have experience in the type of property that they're seeking to acquire? And do they have experience in the local market where that property is located? So a lot of that is kind of wrapped up into, kind of the experience part of it. The other part of it is, do they have a brand to protect? And are they known in the industry? And if they screw up, then their name is mud? Or are they kind of an unknown that they could completely screw up, create a new company name, bankrupt the old one and start up a new one and nobody knows the difference? I think that's really important because, a sponsor will fight to their death to protect their reputation if they really have a reputation worth protecting. And then the other one is track record. And people talk a lot about track record and they think that track record means, what kind of returns did you produce? Or how did the returns that you produce compare to the returns that you projected? And I think you've got to really take your track record examination a few steps further than that, because returns really are dependent a lot upon context. What kind of underlying market conditions were present. Just because you got outsized returns doesn't mean that maybe happened during a massive bull cycle in real estate and had nothing to do with the smarts or of the sponsor. But think about things like what was their performance like in a down cycle? Have they ever lost investor principal? Have they ever survived a market cycle without losing investor principal? What does their current portfolio look like? When were the properties acquired and how were they financed? Are they facing a lot of potential distress in their near future? Like, for example, they bought most of their portfolio in 2021, 2022, 2023, financed on 3-year maturity bridge debt that's coming due, and now the lenders are knocking on their door. If that's the situation, they're going to have a lot of fires to put out and maybe not as much bandwidth to pay attention to the investments you're considering making. So there's a lot of nuances to track record that go just beyond looking at returns.
Yeah, so that's the main thing you look for that you stated in the book. And you also go into how you look at the numbers as well, and what the deal actually is that the sponsor is investing into. Because you put the sponsor number one and then the deal second. So could you go into details about, obviously there's all different types of asset classes and types and markets. So what do you look for in a good deal?
Well, you're looking at, there's this whole crowdfunding thing that started several years ago that created this marketplace kind of environment around passive investments where, you look at your computer screen, you got 18 investments to choose from. You look for the one that has the highest projected return and you choose that one because it has the highest projected return. When, what I talk about a lot in the book is getting behind those numbers to figure out how they arrived at the projected return and what the inputs are that result in that particular output, and analyzing those inputs are really important. What kind of rent growth are they projecting? What's the exit cap rate that they're projecting, and does that exit cap rate make any sense at all relative to where the market currently is or where the market may be? What kind of expense projections are they making, and expense growth projections are they making, and are those within reason and within market? What kind of post-renovated rent bumps are they projecting that they can get? And do the market conditions support those kind of renovation increases? So there's a lot of nuances, in the so-called underwriting, which is what how those returns are calculated, and knowing that garbage in equals garbage out, and understanding how the sponsors are arriving at those estimates is really critical when you're evaluating the deal.
Of course. Yeah, and that's if you're looking at a syndication, and there's also funds that people invest in with multiple deals. So how do you look at the difference between syndications, which is deal by deal, and the fund, which encompasses a whole bunch of deals?
Yeah, funds are a whole different deal because you don't get to see what the assets look like and how the assets are projected to perform. Here you're just making a bet entirely on the sponsor. So in the case of a fund, what you want to see is how has that sponsor performed in down cycle markets? Have they lost investor principal? You want to see how long they've been in business. It really goes back to their previous history and track record and experience. And if you have a highly experienced sponsor with a long-term track record of delivering results and never losing investor money, then if you like the strategy that the fund is engaged in, then that might be a good place to invest. Now you can get these what I call semi-blind pool funds, which are a bit of a hybrid of the two, where you find a fund, you really like the strategy, you like the sponsor, but they're doing an initial set of fund assets where you actually can see the first tranche of assets that are going to be acquired by the fund, and you can see the underwriting and underwrite it just like you could a single asset syndication to get kind of a better idea of what the rest of the assets in the fund may look like and how their performance might be calculated. But some people say that they only invest in single asset because they can see all the underwriting and all that stuff. They forget that the underwriting is really just a guess. I mean, if you really bake it down, I mean, the sponsor is making an educated guess on rent growth. They're making an educated guess on rental rates. They're making educated guesses on expenses and expense growth and exit cap rates, and coming up with what they think the returns may look like. And the only thing I can guarantee you is that the one thing that will not happen is those numbers will not exactly be achieved. They'll be either higher or lower, but they're not going to nail it. So, while it's nice to be able to double check the sponsor's underwriting, it's not the biggest deal really when you bake it down. What really matters most is the sponsor's experience and track record. And if they've got a really good, solid experience and track record, then they should do a good job with the fund.
No, of course. Yeah, and a lot of people that invest into these funds, maybe doctors or lawyers that have a high income, they want to receive passive income. They don't get to look at a whole bunch of opportunities because they're not in the space full time. So what would your suggestions be for a high net worth investor to increase their deal flow from sponsors so they can look at more and get more practice evaluating these opportunities?
Yeah, there's you just have to get involved, really. I mean, there's things like, going to conferences, you can meet sponsors, you can watch podcasts and contact, people that you see as hosts or guests on podcasts and get on their mailing lists, so that you're getting it direct. I mean, I kind of personally like those approaches of, seeking out people that you think, would do a really good job in getting on their list and looking at their offerings. There's also services out there now that offer kind of like, I don't say marketing necessarily, but they provide some level of deal flow. I know there's one called GPLP Match you can sign up for, and they just like people put deals on there and then those get sent out. Being a part of a community is really helpful. There's like the 506 group, there's Passive Pockets, which are communities where you join and, members talk about how their investments are performing and what investments they're seeing, and you can see some deal flow that way.
Yeah, and also joining those communities, the members, it's private, so they give, critical feedback to sponsors and maybe some things to look out for as, the pros and cons of these investments. So what are the red flags in, say you're looking at a syndication, what are some example red flags that an investor might not think of just coming into the space?
Well, one of the big ones that you've seen a lot of recently has been, sponsor experience, and just like brand new sponsors doing their very first real estate deal, raising money for big money deals. That's a major red flag because they just don't have the experience. They're just not ready for that yet. Another big red flag is financing structure. When you see short-term maturity, high leverage financing structures, bridge debt, 90% loan to cost bridge debt is, to me is a big red flag. Another one is when you see multiple classes of equity where you might see, high leverage, first lien debt followed by preferred equity, followed by a syndication with a split share class structure where they have like a Class A share that has priority over Class B shares, which has priority over Class C shares, and you're investing in Class C. That means you're like the fifth or sixth person in line to get paid. That to me would be a big red flag. Over enthusiastic underwriting, I think, is always a bit of a red flag. But really, the things that have been catching people off guard over the last 3 years and causing syndication failures has generally been over leveraging and short-term loan maturities and layers upon layers of engineered structured finance with things like, priority preferred equity and things of that sort. And that's the things I'd be looking out for.
Yeah, and what are some green flags you would look for?
Green flags are low leverage. So if you've got, say, 50, 60, 70% loan to value, acquisition debt, a single share class where right behind the acquisition debt is the class of shares you're investing in, and you're the only class of shares where there's really only two people in line. When that project sells, two people get paid: the lender first, the investor second. That is at least a bit of a green flag. Obviously, it doesn't mean you don't do your due diligence on the sponsor and all the other homework, but certainly the investments, even in this downturn, the investments that had lower leverage points and a more simplified equity structure are surviving. Now, they may not be performing to expectations because the market has gone through some major turmoil, but they're not likely to result in 100% wipeouts of the investors like the ones that have, the complicated capital stacks.
Yeah, and on a different note, you've taken a pause on multifamily investing, which you've done for about 35 years. So could you explain why you've taken a break and shifted your strategy?
Yeah, so in 2021, there had been some major upswings in pricing in multifamily. There was massive rent growth taking place at the time post-COVID. There was just a tremendous amount of buyer interest. Really risky financing structures, high leverage bridge debt was very common. And I just felt that, this was a really good time to be a seller. It was a terrible time to be a buyer because you'd try to buy something and you'd get outbid by millions of dollars by multiple offers. And so we had a property that we got an unsolicited offer on that was way more than we ever would have imagined. And we thought, well, if you want the property that bad, you can have it. And while we're at it, why don't we try listing another asset and just see what happens? So we did, and we had 24 offers that went way over what we would have expected, with 7-figure non-refundable earnest money deposits at contract signing. And it's just all those, were signs and symptoms of a massively overheated market. So we pivoted and became net sellers, and we aggressively sold 3,000, 3/4 of our portfolio, 3,000 of our 4,000 units. We sold them right before the market, really started collapsing. And then by the second quarter of 2022, we saw that the market was clearly in, a massive decline. Rent growth had gone away, it was turning negative. Vacancies were increasing, pricing was decreasing, cap rates were expanding, and that's the catching a falling knife type of scenario. So we just opted to sit on the sidelines. I like to say that there's a time to buy, there's a time to sell, and there's a time to sit on the beach. So we spent 3 years sitting on the beach. You don't want to sell anything you got. You got to ride it out. You certainly don't want to buy anything because the market's falling, but it's a great time to be watching from the sidelines and waiting for the market to bottom. And so that's exactly what we've been doing.
Yeah, and sometimes, because you're a motivated guy, sometimes that's hard to do. So now you're raising a $50 million fund. Could you explain what you're investing into and the business plan there?
Yeah, well, kind of similar to how we saw multifamily went into a decline in 2022. We also recognize that the healthcare real estate sector, specifically skilled nursing, assisted living, and memory care, went into a massive decline immediately after COVID because the pandemic literally killed their client base. I mean, literally. I mean, there was massive die-offs in elderly population as a result of COVID, and that resulted in significant financial hardships for those facilities. And so they started going into a bottom sooner than multifamily, and they've been kind of in a recovery phase for quite some time now. So it started at probably about 2023, I would say, right around in that range. They started to get in recovery where they were, building back their client base again and, refilling beds and increasing occupancy. And, now they're just climbing out of their down cycle. Bottoming is a process. And, in this kind of real estate, I like to buy when you're coming out of the bottom, not when you're going into the bottom, not when you're necessarily at the bottom, but right when you're starting to come out of the bottom, I think is a really good time. And this particular asset class of skilled nursing, assisted living, and memory care is just coming out of the bottom and has very clear signs of massive upward potential. In fact, after we began this strategy, I start seeing article after article about how senior housing is going to be one of the top two, right, along with data centers, in terms of performance in the commercial real estate sector for the next 3 years. So, part of being a really good real estate sponsor is to find the right opportunities at the right time. And I think that that's what we've done here is we found the right opportunity at the right time. And more importantly, we have the right team in place to do it. It just so happened that a friend of mine who was the president and CEO of a healthcare REIT that bought skilled nursing, assisted living, and memory care, it is now on my team. So to have 20 years of experience and millions of dollars of transactions in the senior space on my team to help us execute the strategy means that the timing is right. It means that the team and the experience is right, and that's why we launched that fund.
What other asset classes did you look at before you landed on, the skilled nursing and senior living?
I look at every asset class and, literally everything. I look at single family, multifamily, industrial, office, retail, data centers, all of those different things. I pay attention to all of those. What I've found over my career, and I've invested in and actually been an owner of properties in most of those sectors. I've owned self-storage and hotels. Just all different kinds of things I've had experience. I've found that my core competency is in multifamily. And so I pretty much stick to multifamily. And, the reason we're able to execute on the senior housing strategy is because I've got Kent on my team, and he's an absolute expert in this space. And that allows us to be able to capture, all the stuff we're buying is off-market deals, direct to seller, no brokers, just really, really, really good solid deals. And, you can't get that without the right relationships. So I don't have currently anybody on my team with the relationships and skill set in data centers or in industrial. And those are probably the other two top sectors right now. If I had the right team in place, maybe I would consider it, but I'm not going to go just try it on my own and see if I can figure it out when, investor money is on the line. So a lot of it really comes down, before you execute, you want to make sure that you've got, the right people in place or just don't execute.
Yeah. And you've already built that partnership with your friend and because you're coming from multifamily, you already have the investor base and he has, the experience in the space. So it's good to partner with someone like that. What markets are you guys targeting with the fund?
So we're actually kind of doing this in reverse of what most people would do. Is most people would target a specific market or target specific properties and then try to figure it out. We're doing this in reverse, where we're looking specifically for really strong operators, because the way we are doing skilled nursing and assisted living and memory care is we're not actually operating the facilities. We're buying the real estate and triple net leasing it to best-in-class regional experienced operators that actually run the day-to-day patient care aspect of the business. We don't want to be in the patient care business because that's not our core competency. So what we're doing is we're looking for those top tier regional operators and then finding facilities that they either already run and manage that have ownership challenges, because generally the operators don't own the real estate. We're looking for ones that have ownership challenges, or we're looking for facilities that ran into trouble during COVID, but we have a great regional operator in the area that's already entrenched in the market that would take that facility over and turn it around. So we start by looking for operators, and then we start looking for real estate. And we're nationwide. We just closed on 9 properties in Iowa. We've got 5 more properties in contract, 2 in Iowa, 1 in Oklahoma, 1 in Indiana. We've got LOIs under negotiation for assets in California, of all places, which would be the first time I've invested in California in a while. and a couple other states as well. So we've got a broad footprint, and fortunately, we've got experience all across the country, so we could go just about anywhere that it makes sense.
Yeah, and how are you guys increasing your deal flow with these operators and with these sellers? Because you go direct to seller, you don't use any brokers.
Yeah, it's all relationships, and like I said, we've got Kent on our team has just a really deep bench of relationships with operators and owners because he's been in this business for 20 years and just knows everybody in the industry. So a lot of it is just calling up his friends, what do you got and who do you know, and where are you seeing opportunity and challenges, and and kind of one conversation leads to another. We're not sending out postcards or, doing direct mail or, anything like that. It's all about just pick up the phone. It's old school shoe leather. Pick up the phone, get on a plane, travel around, talk to people and find needles in haystacks.
For sure. And it's much more personal when you get to know them, know the seller or know the operator on a personal level. So what are the plans for the future of your firm? You've kind of transitioned from multifamily, been doing that for a while, and now you're in senior living, which is nationwide. How do you see, the growth of your firm in the next 10 or 20 years?
Probably sticking to those two sectors. We've kind of built really incredible parallel platforms where I have a great team on the senior housing platform, and I have a great team in our multifamily side, which we've retained the entire team. Some of the people are actually in both disciplines and helping out with things on both sides. But I wouldn't say that we turned away from multifamily or that we've necessarily pivoted. What we've done is we found an incredible opportunity at the right time with the right people, and we're capturing it. There's not that good of an opportunity right now, in my opinion, in the multifamily side. And so we're still, quote unquote, sitting on the beach, from that perspective in that side. But as soon as I see that the opportunity comes back and that cycle has matured and is beginning to climb out of that cycle, which I think will be probably 2027, then we'll most likely, rev the engine back up and start making some more acquisitions on the multifamily side again.
Awesome. Yeah, and last question, Brian. If anyone is interested in partnering with you or investing into your fund or deals, how can they reach out?
Yeah, you can always check out our website, praxcap.com. It's praxcap.com. For information on the fund, you could go to investwithpraxis.com. You can also follow me on Instagram at Investor Brian Burke. Check me out on the forums on biggerpockets.com, or get a copy of the book from biggerpockets.com/syndication book.
Awesome. And we'll put those links in the description. Thanks
Right
for
on.
coming on, Brian.
Thanks, Weston. I appreciate you having me here.